Well, good morning. Yes, it's me, Kenny Polcaro, your host of the party. And today is Monday, September 30th, 2024. And here are the things that you need to know to get your day started. Well, it is September 30th, so it's the end of the quarter. October 1st is tomorrow. Bonds are up. Oil is kind of mixed while gold is kissing all-time highs. Earnings season is about to begin, and dock workers are threatening to walk off the job tomorrow. And Joe Biden says that he's not going to intervene. And what are we having for dinner tonight? Well, this is really a great dish and simple to make, but something you can use as an appetizer or a main dish. It's the risotto pomodoro, right? So it's risotto with tomatoes. Very, very delicious. Okay, so on Friday, some stocks clung on to the recent gains while other stocks just appear to be exhausted. Bonds rallied, causing yields to come in a bit across the curve. The 2s, the 5s, the 10s, the 20s, and the 30s. Oil also rallied. Gold gave up $14 an ounce. The dollar index fell another 0.15%, all while the VIX may be signaling of trouble ahead. On Friday, it rose by 10.4% to end the day at 1696, stuck between the short-term trendline resistance up at 1825 and long-term and intermediate-term trendline support down at 1555, 1480-ish. All happening as the Fed and most of the Fed heads try really hard to assure us that nothing is wrong, that we're not going to go over the cliff, that there's nothing to see here as they get ready to cut rates by another 50 basis points in early November. Because, as I said, there's absolutely nothing to see here. Now, both the S&P and the NASDAQ lost ground, right? The S&P down 7, the NASDAQ lost 70 points, while the Dow gained 138 points, the Russell added 15 points, the transports was up 102, while the equal-weighted S&P rose 27 points. On the economic front, the Fed's preferred gauge of underlying U.S. inflation came in as expected. No real surprise. Personal income and personal spending came in just below expectations, while the University of Michigan Sentiment Survey rose from 69.4 to 70.1, suggesting that consumers are not anxious at all. Then we have guys like Chris Larkin at E-Trade. He tells us that growth may be slowing and that we're not going off the cliff, while Damien McIntyre of Federated Hermes, with $785 billion of assets under management, tells us that we should find solace in the strength of the recent data. Inflation is falling, the consumer is strong, and the labor market remains resilient. Exactly. So then why are we getting these panicked rate cuts of 50 basis points? Now, I do say most of the Fed heads are trying really hard to convince us that there's nothing wrong, because on Friday, St. Louis President Alberto Mussolin came out and said that he favors a gradual cut, pushing more for 25 basis point cut rather than a 50. While Michie Bowman, who's been, kind of slow all along, has reiterated her view that there's no need to cut by 50 basis points again, and she's not supporting another cut at all. She thinks that the economy is also still strong. All while JJ, in a pre-recorded speech, didn't offer any new details on the path of the future monetary policy moves. And that's because we know how he feels. He told us that 7 days ago, right? He fully expects us to land softly, telling us that the September 50 basis point rate cut was actually a show of strength, right? But he did not necessarily rule out the need to make more drastic cuts in the months ahead. On Saturday morning, Nikki T from the Wall Street Journal published a piece that said the quiet part out loud. The headline reads, "Rate cuts don't guarantee an economic soft landing." Now, remember what I always say. When the Fed wants to put an idea out there and they don't want to actually say it, they leak the idea and the story to Nikki or to Goldman Sachs, and they write a piece or they write a breaking report as if it's their thought, as if it's them that is questioning the policy. Do not forget how Nikki published a piece suggesting that the Fed needed to cut rates by 50 basis points just 4 days ahead of the September 18th FOMC announcement, when the Fed was in blackout mode and prohibited from talking to the media. Kaish? Remember, the narrative going into the meeting was calling for 3 25 basis point cuts at the next 3 meetings, and then suddenly it changed. So they leaked that story to Nikki ahead of the move, and boom, the next day, there's a story in the Wall Street Journal. Now, the truth is that it's all going to depend on exactly what we see when we pull back the sheets on the U.S. economy. Nikki lays it out. He lays out the argument like this, and I quote, "A soft landing that brings inflation down to the Fed's goal without major deterioration in the labor market could still be tricky to achieve because it requires growth in new lending to pick up. Bank lending has slowed to a crawl over the past year, something not usually seen outside of recessions. If borrowers or businesses are reluctant to obtain new borrowing, rate cuts might do very little to boost the economy. At issue is the difference between the marginal cost of debt, which is falling, and the average rate on debt, which might still rise, particularly for borrowers who locked into rates before the Fed started hiking. In the end, it's not really clear that a 50 basis point cut or even a 100 basis point cut in rates is going to have this soothing effect, because the average interest rates that households and businesses face is still higher than what they have now. And that really, it's kind of around 3%-ish, plus or minus on either side. So unless JJ plans to slash and burn rates, it may not really help prevent us from going into a recession, which, by the way, you know how I feel about it. I don't think that would be a bad thing, right, if we go into a slight recession, because only a recession is really going to fix the problem of higher prices. A recession will cause those prices to come down. And then we have the daily China story that seemed to be largely upbeat. But for me, it seems like the shit is hitting the fan. The People's Bank of China cut mortgage rates for the first and second homes by 50 basis points. They reduced minimum down payments for purchases. They instructed all commercial banks to lower interest rates on all existing mortgages by October 31st to no less than 30 basis points below the PBOC's prime rate. And they're allowing state-controlled banks to lend a larger proportion of their assets to borrowers, right? Chinese stocks surged 26% in the last 5 trading days, going from negative 8% year-to-date to plus 17% year-to-date. I mean, the manipulation is ridiculous. Remember, China is still an emerging market that carries a lot of risk. Yesterday, China's official manufacturing PMI came in at 49.8, a bit better than the August number, but it's the 5th straight month of contraction. All this assumes, of course, that you believe anything that comes out of China, something that I don't, right? I don't believe a word that they say, thus I don't invest directly into China. Overnight stocks in China and Hong Kong surged again, right? China was up 8%, Hong Kong was up 3% as the manipulation continues. Now, today is the final day of the third quarter, and the U.S. futures are mixed as we lock in third quarter performance, right? The Dow's down 30, the S&P's up 3, the Nasdaq's up 14, while the Russell is flat. As of this morning, the Dow is up 1.8% for the month, the S&P's up 1.6%, and the Nasdaq's up 2.3%. The talk of and then the supersized cut being credited for the moves this month, right? Now, potentially the moves next month. Tomorrow starts the fourth quarter, and it is the 1st of October. Again, one of the most volatile and nervous, anxious months of the year. The 11th officially kicks off the earnings season, while the next 5 weeks brings an end to the presidential election, right? Culminating on November 5th, when we hope we should know who's going to occupy the White House as well as Congress. Eco data this week includes S&P manufacturing, ISM manufacturing PMIs expected to remain in contractionary territory. S&P services and ISM services PMIs, which are expected to remain in expansionary territory, right? So there's the yin-yang. Construction spending up 0.2%. JOLTS job openings, Dallas Fed services activity also due up. On Wednesday, we get the ADP employment change, which is expected to create 125,000 new jobs. And then on Friday, the all-important non-farm payroll report that is expected to show an increase of 146,000 new jobs, although the whisper numbers are betting on significantly less. Unemployment remained at 4.2%. Average hourly earnings up 0.3 month over month, and year over year up 3.8%. This morning, oil is up about 0.5% at 30 cents a barrel at 68.25 after the targeted weekend bombings of Hezbollah by Israel. The rising conflict now raising possible supply concerns as the conflict has the possibility of drawing Iran into the fray. As a key member of OPEC, the risk of supply disruptions rises if Iran gets more involved than they already are. Gold, as you imagine, is a beneficiary of all this conflict in the Middle East, right? As gold remains the ultimate safety play. Gold is also betting on another bonus-sized rate cut in November, right, at the next November Fed meeting. Remember, lower rates equals a lower dollar equals higher gold and other commodity prices. This morning, gold's up $10 at $26.78 an ounce, trading just below the high made last week at $27.08. Any pullback, though, in gold could easily see us test 2,600, a level where there is some support rather quickly, although the trend line support is down at 25.34. The VIX is churning, trading as high as 1710 overnight, as it too awaits the next headline. If it breaks resistance at 1829, it could easily spike to the September highs of 2330, which is a 27% surge. And if it really gets anxious, then strap in, because you could see a swift surge even beyond that. European markets are under a bit of pressure on this last day of trading in the quarter. Italy's down more than 1%. France is down 0.9, while Spain and the UK are off about 0.2%. The tone this morning is a bit negative after automaker Stellantis trimmed their 2024 guidance to reflect global industry dynamics, as well as rising competition from who? China. The S&P closed at 57.38, down 7 points. While futures are showing little direction, my sense is that we're not going to see a lot of action other than some last-minute markups and markdowns in the final minutes of trading today as asset managers close out their books for the quarter. I would say brace yourself for October. 85,000 dock workers are on the verge of striking, affecting 36 U.S. ports, right? Joe Biden, if you saw SNL on Saturday night, you'd understand Maya Rudolph was hysterical, refuses to intervene even as the strike threatens to shut down ports and snarl U.S. trade. Railroad shippers are already turning away refrigerated goods for fear of no one to unload them. The union is calling for workers at all Atlantic and Gulf Coast ports to walk out on midnight Tuesday if a new contract is not agreed upon by the USMX, saying, and I quote, "The USMX refuses to address a half-century of wage subjugation where ocean carriers' profits skyrocketed from million to mega billion dollars while longshore wages remained flat. The walkout would affect 14 ports along the eastern and southern coasts, while concerns are mounting from the left over the economic impact of a strike on early voting." Now, I expect that we're going to see a pullback in the market. I've been saying that for weeks now. But if we see anything more than 5 or 8%, then let me remind you, the Fed's going to remind us of another bonus cut that's only a couple of weeks away. And that's all, and then it's all systems go, right? The Fed is not going to let the market collapse weeks ahead of this very contentious presidential election. They're just not, right? A little bit, yes, but they're not going to let it fall out of bed. And if they do, then we're in real trouble. In the end, it is what it is. Don't let your emotions get the best of you during this chaotic time. Stay focused. Building a strong, well-diversified portfolio takes time and commitment. Okay. So now, what do we have for dinner tonight? This is really it's a risotto, but it's risotto made with tomatoes, and it's a delicious, delicious dish, right? It's called risotto pomodoro, which is tomatoes. Okay, so for this you need 1.5 cups of arborio rice. You need one white onion that you're gonna, yellow onion that you're gonna dice. You need 1 cup of red wine. You need a vegetable broth, maybe like 64 ounces. You may not use all of it. You need 1 can of crushed kitchen-ready tomatoes. You need fresh grated Parmigiana cheese, olive oil, salt and pepper, burrata cheese, and fresh basil. You want to heat up the vegetable broth in a separate pan. Now, while that's heating up, you're gonna grab a heavy bottom pan, and you're gonna heat up some olive oil. Now you're gonna add in the onions. You're gonna saute it until it's nice and soft. When it's done, you can add in the rice and stir until toasted. Here, I'd add a dollop of butter too, but that's just me. Next, add in a cup of the red wine, like a Cabernet Sauvignon, and stir it until the alcohol evaporates and the wine is absorbed by the rice. Now add 1 ladle of the hot broth and stir it and let it absorb into the rice. This is where you have to stir, right? You're gonna add another ladle when it's all absorbed, and then add in the crushed tomatoes. Season it with salt and pepper, stirring as the rice absorbs the broth. Repeat until the rice is firm to the bite, but not hard. Turn off the heat, add 1 more ladle of the broth to keep it moist, add in the basil and the fresh grated Parmigiana cheese, like a couple of handfuls, mix it well, and then serve it on warm plates. Top this with a few dollops of the burrata cheese. It is delicious. In any event, it is a spectacular day here in South Florida. The sun is out, the sky is blue, a little bit cloudy, but nothing dangerous. Until tomorrow, take good care.